want to switch gears now and talk about the market, which obviously took off today on the news that John McCain, whom many thought was entrenched as a no vote, would actually support the Senate tax bill. Now, there's no doubt investors are clamoring for lower corporate taxes because it would mean bigger earnings per share results, and earnings ultimately are the key to market valuation. Moreover, this gives businesses room to hire more workers and make greater long-term investments. But I continue to urge investors, and would-be investors, by the way, to understand the most important driver of this rally is a reawakening of America's DNA. Its historic inclination to lead and to excel. It's not a political comment to say corporate America spent the past 8 years in a foxhole, while the American consumer played it very close to the vest after losing all of their confidence. In fact, one way to measure consumer confidence is corporate revenue growth, which has been in a tailspin since 2011. In fact, 5 of the last 7 quarters going into this year saw declines year over year. Well, that's changing big time. In the second quarter, S&P revenues grew at a blended rate of 4.3%. And so far, with 98% of the names reported for the third quarter, that number has accelerated to 5.8%. And then we move down the income statement to earnings, which can be impacted, of course, by a lot of different things, including corporate buybacks and, of course, taxes. Last quarter, 74% of companies beat the Wall Street estimates on a bottom line. The blended rate, 6.3%. That's almost 2 times what was expected. Now, currently, Wall Street anticipates even more robust revenue and earnings growth going into the first half of 2018. All of this, by the way, before the GOP tax plan is even implemented. Take today's winners, for instance, okay? They reflect renewed Main Street enthusiasm, but also underscore the magic that could come if we saw a sharp reduction in corporate taxes. Retailers, Kroger, posted a great financial number. It wowed Wall Street, wowed investors. You had strong comparable sales numbers. The shares are up 6% today. Same thing with Costco. Comparable sales there at stores, if you don't count the gas stations, up an impressive 8.4% in the United States. Now, here's the thing. Both of these retailers paid an effective tax rate of almost 33% last year. Transportation had a great day. In fact, a very strong session. The biggest winner in the Dow Jones Transportation Index was Southwest Airlines, up 3% for the session. Now, last year, they paid an effective tax rate of almost 38%. Again, think about that. If it was 20%, what the stock do? Then their financials. A combination of moderately paced interest rate hikes next year and a stronger economy will help the money center banks as well as regional banks. Today it was Goldman Sachs, up almost 3%. You know what they paid last year in effective tax rate? Try 28%. So here's the bottom line. We are in the midst of a manufacturing renaissance, and it's underscored today by the Chicago PMI number. The Midwest is on fire. The bottom line, the economy is on a roll. And guess what? It's not going to stop, even if Republicans snatch defeat from the jaws of victory, which I hope they won't do. Now, I will say this. Volatility could increase, and of course, there could be some selling on the news, even if this deal goes through. Your investment proposition, though, goes way beyond tax reform. America is back. This rally, in my mind, has a very long way to go.